Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is May 22, 2026. We're Elena and Marcus.
And if you're managing risk today, you are staring at a massive contradiction in our daily desk data.
Right. I mean, imagine a market where the Federal Reserve explicitly threatens to hike interest rates, and yet, well, stocks hit all-time highs anyway. They're completely brushing off the rising cost of capital.
Correct. Today's data deck is complex, but we've distilled it down to 4 critical themes you need to navigate this environment.
So first, we've got a historic transition at the Federal Reserve. This was marked by a White House swearing in and a really severe hawkish pivot from a key governor.
Right. Second, we're tracking this highly unusual curve twist in the Treasury market. And that's driven by rate hike pricing on one end and Middle East peace optimism on the other.
Third, there's a broadening equity melt-up. It pushed the Dow past 50,830 today, fueled mostly by resilient corporate earnings and this relentless AI infrastructure demand.
And finally, a stark divergence between Wall Street records and Main Street consumer sentiment.
Moving to today's data, let's examine the primary macro driver here, because it's undoubtedly a tectonic shift in monetary policy signaling.
Indeed. Kevin Warsh took the oath as the 17th Federal Reserve Chair today. And from a structural optics standpoint, doing this at a White House ceremony is something we haven't seen since Alan Greenspan in 1987.
Right, and 1987 was a period of intense market volatility.
Correct. So paralleling that era underscores his explicitly reform-oriented mandate. I mean, when you see a Fed chair sworn in at the executive branch rather than the central bank, it signals a potential shift.
A shift in how monetary policy interacts with fiscal policy, you mean?
Exactly. It introduces a layer of institutional uncertainty right as the economic data is hitting a critical inflection point for your portfolios.
Understood. But the more immediate shock to our models today, I think, came from Frankfurt.
Right, Governor Waller's speech.
Yeah, delivering this on a global stage, with European central bank officials watching closely. Fed Governor Christopher Waller delivered a speech that fundamentally reset the policy trajectory.
And we really have to contextualize this for you. As recently as January, dealer desks had positioned Governor Waller as a noted dove.
Right. But today, he explicitly called to remove the Federal Open Market Committee's easing bias.
Which, for context, an easing bias is just the market's assumption that the central bank's next move is guaranteed to be a rate cut.
Right. And he stated, point blank, that a rate cut is no more likely than a hike.
Correct. That specific phrasing, that's the catalyst for the violent repricing we're seeing across asset classes right now. Institutional consensus expectations for Q2 PCE inflation have now moved up to 3.9% year over year.
Almost 4%.
Right. So when you pair an inflation rate nearing 4% with a reform-oriented Fed chair and a formerly dovish governor putting hikes back on the table, the market really has no choice but to adjust its terminal rate assumptions.
Which is the exact level where investors believe interest rates will ultimately peak and hold.
Indeed. And adjust it did.
Yeah, when you look at the swap lines in our latest run, bond traders have now fully priced in a 25 basis points rate hike by December 2026.
Which is a major threshold moment.
It is. It's the first time a hike has been fully priced in this entire cycle. But this is where the mechanics in our daily desk data become, well, highly irregular.
The curve twist.
Right. So let's apply our first principles rule here. Just to explain the curve twist we saw in today's Treasury data. The 2-year yield spiked by 6.4 basis points, hitting 4.126%.
Right.
Yet the 30-year yield actually fell by 2.1 basis points, down to 5.066%. Usually those maturities move in tandem. I'm assuming the long end is dropping because of the diplomatic news out of the Middle East, compressing the energy risk premium.
Correct. It comes down to the distinct economic drivers of different durations on the yield curve. So the front end, specifically the 2-year Treasury, is hypersensitive to immediate Federal Reserve policy.
Right, because of short-term borrowing.
Exactly. When Governor Waller threatens a hike, the cost of capital for the next 24 months reprices violently upward because, auto loans, credit cards, short-term corporate debt, they're all tethered to that front-end rate.
Which explains the spike past 4.1%.
Right. Meanwhile, the long end of the curve, the 30-year Treasury, tracks structural, long-term inflation and growth expectations over decades.
Understood. So the market is pricing in a tighter Fed today, which pushes short-term rates up. But it's also pricing in lower structural inflation tomorrow because the geopolitical risk to energy supplies is fading.
Indeed, it is a textbook bear flattening at the front end of the curve, paired simultaneously with a bull steepening at the back end.
Which is a lot of jargon.
It is. To break that down for you, a bear flattening just means short-term rates are rising faster than long-term rates. It's flattening the gap between them. It's a classic signal that the market expects immediate Fed tightening to cool the economy.
Right. And at the exact same time, long-end yields are falling on that geopolitical optimism you mentioned. We tracked intensive diplomatic progress in Iran-U.S. peace talks today, which directly pulled down the long-term energy risk premium.
On that point, looking at equity flows, the broader market largely ignored the front-end rate shock. They leaned entirely into that geopolitical optimism.
Yeah, the S&P 500 closed at 7,473.47, which is up 0.37%.
That marks an 8th straight weekly gain.
But, if you're managing allocations, the headline index level is far less significant than the underlying breadth quality we're seeing in today's proprietary updates.
Correct. The breadth metrics are highly constructive right now. The equal weight S&P 500 outperformed the cap-weighted index by roughly 54 basis points. It gained 0.91% on the session.
And we also saw the Russell 2000 gain 0.91%.
Right. And to understand why this matters, remember that the standard S&P 500 is cap-weighted. That means its daily performance is heavily skewed by just a few massive technology giants.
Right. So if those 5 giants have a great day, the index goes up, even if the other 495 companies are deeply in the red.
Exactly. But the equal weight index treats all 500 companies exactly the same. So when you see the equal weight and small cap indices outpacing the mega caps, it tells you the average business is finally winning.
It signals fundamental institutional buying.
Right. Broad market participation across multiple sectors rather than just a handful of giants dragging a tired market higher. It is a durable rotation.
Indeed. And the corporate movers confirming that durability are specific and varied today. Dell surged 16.77%, making it the standout winner in the S&P 500 on an AI infrastructure earnings beat.
But it wasn't just semiconductor and server names.
No. Workday added 5.16%, Zoom added 9.19%, and Ross Stores jumped 8.11%.
Right. So when enterprise software, communications, and off-price consumer retail all beat consensus simultaneously, it proves that both corporate capital expenditures and consumer spending remain remarkably resilient.
Though Apple also contributed heavily to the index gains today, adding 1.26%. They acted as a primary driver of the S&P's positive close.
Moving to today's data, let's unpack why that specific combination of winners matters to you. Off-price retail, like Ross Stores, surging alongside enterprise software like Workday, illustrates a bifurcated but functioning economy.
Right, it suggests consumers are still spending, albeit hunting for value.
Correct. While corporations are still investing heavily in human capital and productivity tools. But the underlying current beneath this entire equity resilience remains the AI infrastructure constraint.
Which brings us back to the hardware.
Right. Our internal desk data tracking daily rental prices for GPUs illustrates extreme price appreciation as compute scarcity intensifies. What really stands out in today's data deck is the surprising resilience of legacy assets.
Like the A100 chip.
Right. The A100, for example, is currently holding a steady bid at roughly $1.50 per hour.
Understood. Which seems highly counterintuitive. I mean, if enterprises are deploying next-generation architectures like Rubin and Vera Rubin, why are they paying a massive premium to rent older hardware?
Correct. It speaks to the severity of the compute bottleneck. Enterprises are basically being forced to optimize for token efficiency amid widespread compute scarcity.
Because modern AI models are running more complex agentic processes.
Right. They require deep memory context rather than just pure processing speed. In other words, if you want an AI agent to read an entire financial report and summarize it, it has to hold that massive document in its active memory.
So companies are heavily utilizing older utility assets like the A100 because they just need the sheer volume of video RAM to keep operations online.
Right. Even if the math operations take a fraction of a second longer.
On that point, it is hard to look at these power grid, memory, and physical chip constraints and not think of the late 1990s telecom boom. We had the exact same scarcity with fiber optics back then.
Oh, absolutely. Well, I should say the parallels are striking.
Right. But in 2000, fiber optics eventually shifted from a state of critical scarcity to massive permanent abundance. Are parts of the current AI market discounting extraordinary demand assumptions while completely ignoring how fast supply engineering might catch up?
Indeed. That is a precise structural vulnerability in the current multiple expansion. The market assumes the compute bottleneck is a permanent feature. They're pricing hardware providers as if the current scarcity premium will last indefinitely.
But history shows that capital naturally flows to relieve bottlenecks.
Right. Supply engineering eventually catches up. The underlying demand for AI doesn't disappear, but the profit margins associated with artificial scarcity inevitably compress once supply arrives faster than the market models anticipate.
Understood. And we're already tracking massive capital flows aimed at exactly that. Institutional consensus projections show a looming $600 billion wave of equity supply in 2026, and roughly $160 billion of that is coming from IPOs.
There has been anxiety that this supply could overwhelm the market.
However, our daily desk data contextualizes this for you. As a percentage of total market cap, this upcoming supply is easily absorbable. The total market capitalization is vastly larger today than it was decades ago.
Right. It pales in comparison to the structural dilution we saw during the 1990s tech bubble, or the 2009 financial recaps, or even the 2021 S boom. The system has the liquidity to absorb it.
Moving to today's data, let's look at hard assets. And that exact geopolitical optimism we're seeing prop up the Dow is what is simultaneously pulling the rug out from under the commodity complex.
Right. The commodity complex today functioned as a real-time barometer for geopolitical risk. Energy prices declined across the board.
WTI crude dropped 1.03% to $97 per barrel. Brent dropped 0.73% to $104.15 per barrel. And natural gas saw the most severe reaction, plunging 2.67%.
Indeed. We can trace this directly to the intensive U.S.-Iran diplomacy unfolding today. We tracked a Qatari negotiating team arriving in Tehran, with Pakistan's army chief also mediating.
And Secretary of State Rubio cited good signs regarding the negotiations.
However, it's vital to note that the Iranian foreign minister cautioned that a deal is not close. He cited deep and significant differences.
So the market is aggressively pricing in a de-escalation, effectively removing the supply disruption premium from energy prices. But the diplomatic reality remains highly fragile.
On that point, that geopolitical relief valve in energy stands in sharp contrast to the reaction in precious metals. Gold fell 0.74% to $4,510.50 per ounce, and silver dropped 1.08%.
Now, if geopolitical risk is fading, that partly explains it. But I imagine the real headwind here is the Fed policy shift we discussed earlier, driving up real yields.
Correct. The drop in precious metals is directly attributable to Governor Waller's hawkish pivot. When the market prices in a rate hike, it drives an immediate spike in real yields.
Which is the return you get on bonds after accounting for inflation.
Right. And it drives corresponding dollar strength. Gold yields no interest. So when bond traders fully price in a 25 basis points rate hike, the opportunity cost of holding a non-yielding asset like gold rises.
And it naturally reprices lower.
Exactly. Furthermore, commodities are priced in dollars globally. The dollar's advance acts as an immediate headwind for dollar-denominated stores of value.
Understood. But copper completely ignored the rate hike fears. It rose 1.37% today to 634.5 cents per pound. If rising rates and a stronger dollar pushed gold and silver down, why is copper actively diverging and breaking higher?
Indeed, because copper is trading entirely on the growth narrative. It's prioritizing industrial realities over the rate narrative. Our daily desk data indicates copper is being driven by two overwhelming forces.
Chinese demand optimism being one of them.
Right. Potentially aided by the lower energy import costs from the yarn peace deal. And the second is the immense physical requirements of the global AI data center build-out.
Because data centers are not just racks of servers.
No, they are massive industrial facilities. They require hundreds of miles of copper cabling for power transmission, heavy-duty transformers, step-down substations, and intensive liquid cooling infrastructure.
So the market views copper as a primary bottleneck for AI physical infrastructure,
making it highly inelastic to a 25 basis point shift in Fed policy.
Correct. Bringing this all together, we have to synthesize these conflicting signals for you. We have a fully priced rate hike by December, falling oil prices, and broadening equity records pushing the Dow past 50,830.
Right.
What does this combination suggest about the broader economic regime we are entering?
It suggests the market is aggressively attempting to price in a perfect soft landing. And that's fueled almost entirely by a geopolitical peace dividend.
So equities are willfully ignoring the structural headwind of the two-year yield sitting at 4.126%.
Right. They're treating the potential relief in energy prices as a hall pass to ignore the rising cost of capital.
On that point, the core tension here is in the credit and equity multiples. High-yield ETFs like the underlying vehicles tracking CCC and BAA debt held perfectly firm today.
And to put that in perspective for you, CCC debt is issued by companies with highly leveraged balance sheets.
Typically, this lower-tier corporate debt is the absolute first to fracture when rate hike fears emerge.
Because refinancing their obligations becomes too expensive.
Yet, equities and credit are leaning entirely on resilient corporate earnings, like we saw from Dell and Ross Stores, and falling energy input costs to justify their current valuations.
They're effectively betting that a hawkish, reform-oriented Fed will be neutralized by the disinflationary force of cheaper oil.
Indeed. Which brings us to the underlying fragility of this regime heading into a holiday weekend. With the VIX subdued at 16.7 and consumer sentiment already deteriorating against stock market highs, the margin for error is virtually non-existent.
We are tracking a stark, widening divergence between Wall Street records and Main Street reality.
Correct. And that leaves you with a critical question to consider as you position your portfolios. If the fragile Iran peace talks break down over the Memorial Day weekend, the energy risk premium will instantly return to the long end of the yield curve.
Right.
If the geopolitical safety valve of falling oil shuts off suddenly, can equity multiples survive a direct collision with a Fed that is actively preparing to hike? That is a dynamic to monitor over the coming days.
To quickly recap today's session, a severe hawkish pivot from the Federal Reserve sets the stage for a fully priced December rate hike.
Despite that, equity markets powered through to new all-time highs on broadening breadth and sustained AI infrastructure demand, aided heavily by a geopolitical discount in energy prices. Thank you for listening to Market Pulse by Orestes Capital. We're Elena at Marcus. We'll be back next week with the latest market color. Have a good Memorial Day.